Today, at the limits, the DFA Daily to the 1st of November 2021. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and property news with a distinctively Australian flavour. In today's show, we look at massive overquoting in Victoria, Macquarie's significant mortgage growth, more CBA mis-selling, housing supply equilibrium in New Zealand, and why the RBA is at the end of its capital leash. Wherever you look, we're at the limits. First, The Age says that almost 60% of real estate agents recently audited by the state's consumer watchdog have been hit with fines for underquoting, with the industry put on notice as property sales ramp up following lockdown. Inspectors from Consumer Affairs Victoria arrived unannounced at 29 metropolitan and regional estate agents' offices in May, following tip-offs from the public about underquoting. The Age revealed that 17 of these agents were found to have flouted Victoria's underquoting laws and were fined more than $300,000. Consumer Affairs Minister Melissa Horne said homebuyers should not be deceived when making one of the biggest decisions of their life. Underquoting is not a smart sales tactic, it's illegal. These outcomes serve as a strong warning to agents that if you do the wrong thing, you'll get caught, she said. Concerns about underquoting have intensified during the pandemic as potential buyers have witnessed house prices across Melbourne soaring to a record-breaking median of $1.037 million. The average house price in the world's most locked-down city has risen by almost $150,000 or 16.8% over the past year. Underquoting occurs when a property is advertised at a price below the estimated selling price, the seller's asking price, or a price that has been rejected as too low by the seller. High-end buyers advocate David Morrell welcomed the crackdown but called for harsher penalties for agents found breaching the law, including the suspension of their licences. It's a slap over the face with a wet lettuce. If you're getting a $110,000 fee for selling a house and you get a $10,000 fine, that's nothing, he said. Consumer Affairs Victoria would not disclose which agents had been fined, how much they'd each been fined, and which sales were caught up in the underquoting. Under Victorian law, agents can be fined up to $33,000 for engaging underquoting, while the practice can result in penalties up to $10 million for corporations and $500,000 for individuals under Australian consumer law. Mr Morrell, who is spearheading a campaign for stronger protections for prospective buyers, said underquoting was rife across Melbourne. He regularly sees houses selling for more than $1 million above the top of their advertised ranges and has lodged about a dozen complaints with Consumer Affairs Victoria this year. He said agents underquoted properties because they wanted to glean information about future buyers. It's endemic. If you quote something that is clearly representing unbelievable value, 300 to 400 people will pounce on it. You can get more transactions out of the one transaction. There's also a lot of chest beating. Look at me, I got $600,000 over the reserve, he said. Real Estate Institute of Victoria President Adam Dockings said most agents abhorred underquoting and the practice was uncommon. He said that there was a lot of misunderstanding about underquoting, with many people incorrectly assuming it occurred when properties sold above their estimated range. He said Victoria's rising property market and the pandemic had made it more difficult for agents to accurately price properties. There might be weeks between when the property first appeared and when it went to market, he said. According to Mr Docking, blatant underquoting occurs when offers above a property's estimated range are rejected or when a property passes in above the top of its range. He believes current penalties are an adequate deterrent. Willard's Blackburn director Cameron Way said it made no sense for agents to quote properties at unrealistically low levels to gather information about other potential buyers. Most agents today are extremely time poor, given all the challenges they face each week, and so dealing with a few hundred extra maybe buyers because you intentionally underquote a property is nonsensical and very time wasting, he said. Consumer Affairs Victoria received 383 inquiries and complaints about underquoting between February and the end of April. That's a 129% increase in the same period last year. A spokeswoman said underquoting can distort the property market and lead to potential buyers wasting time and money inspecting properties that were never in their price range. Now, last Friday, Macquarie Group released its half-year financial results, and its home loan portfolio grew 14% to $76.4 billion in the 6 months ending September 21. This powered the banking and financial services arm of the group to deliver a net profit of $482 million, up 52% on the first half. The result reflected strong home loan, business lending, platforms and deposits growth and lower credit impairment charges, partially offset by increased headcount and investment in technology to support growth, the bank said. Its home loan portfolio grew to $76.4 billion in the half, up from $67 billion in the previous 6 months, and that represented 4% of the Australian mortgage market. Its personal banking income, at $125 million, was driven by 27% growth in average home loan volumes. Macquarie noted that its home loan growth was particularly driven by strong demand in lower loan-to-value ratio and owner-occupied lending tiers, and the majority of its mortgage book is for, quote, vanilla, pay-as-you-go mortgages. It also reported lower credit and other impairment charges due to improvements in expected macroeconomic conditions. Indeed, it's been the beneficiary of strong broker support this year, given its turnaround has stayed consistently fast since the coronavirus pandemic hit, while other lenders, particularly the major banks, experienced and continue to experience long blowouts in terms of serviceability. Its banking business portfolio also grew, rising 8% in the previous 6-month period to $11 billion. That was driven by an increase in client acquisition and continued investment in digital solutions for enhanced client experience and to serve clients more efficiently. However, the vehicle finance portfolio continued to drop, falling 5% to $10.9 billion. Macquarie suggested this was 16% lower than average vehicle finance volumes. It's announced the sale of its dealer finance business to Allied Credit over the half, which is expected to complete in December 21. Overall, the whole group recorded a net profit of just over $2 billion, up 107% on the first half, and is in line with the $2 billion net profit for the half ended 31st of March. It said it intends to undertake a capital raising in the form of a non-underwritten $1.5 billion institutional placement and a non-underwritten share purchase plan, the size of which will depend on demand from eligible shareholders. The capital raising, quote, will provide additional flexibility to invest in new opportunities where the expected risk-adjusted returns are attractive while maintaining an appropriate capital surplus. Macquarie Group Managing Director and Chief Executive said this first half saw a significant increase in net profit contribution from all 4 operating groups compared to the first half, a period which was affected by the COVID-19 pandemic. Today's result is consistent with a strong second half and reflects improved trading conditions across our diverse platform. Having deployed $5.5 billion of capital over the second half of 21 and the first half of 22, we continue to see a strong pipeline of opportunities. Raising new capital provides us with additional flexibility to invest in new opportunities where the expected risk-adjusted returns are attractive to our shareholders while maintaining an appropriate capital surplus. Now, elsewhere, the Commonwealth Bank of Australia has pleaded guilty to 30 criminal charges of making false or misleading representation to 165 customers while selling consumer credit insurance. The 30 criminal offences related to CBA's supply of Credit Card Plus and loan protection policies as add-on insurance products sold in branches, by telephone and online. Between 2011 and 2015, the major bank made false or misleading representation to customers that they could make a claim against their insurance policies when some or all of those claims were not available to them. Between October 2011 and July 2015, that's the period of offending, the maximum penalty for those offences increased from $1.1 million to $1.7 million per offence. CBA refunded more than $10 million to 65,000 consumers in 2017 after selling them unsuitable insurance on home loans and credit cards. The matter was prosecuted by the Commonwealth Director of Public Prosecutions after an investigation and referral by the Australian Securities and Investment Commission, or ASIC. The matter has been adjourned to a date yet to be set. CBA's conduct was the subject of a case study by the Royal Commission into Misconduct in the Banking, Superannuation and Financial Services Industry. On September the 16th, ASIC announced that it had filed 30 criminal charges against the CBA in the Federal Court relating to the CBA's promotion and sale of Credit Card Plus and loan protection policies as add-on insurance products in branches by telephone and online. Alleged behaviour focused on whether the bank did not adequately disclose to those customers at the point of sale that they were not eligible for certain benefits under the consumer credit insurance policies because of their employment status. If found guilty, this would contravene the Asset Act. The major bank recently apologised to consumers affected by the unacceptable conduct in former consumer credit insurance sales after acknowledging that criminal proceedings had been filed by ASIC in relation to the sales of those products. By the way, those products are no longer offered by the bank. Last year, Slater & Gordon filed a class action in the Federal Court against CBA and its insurer Colonial Mutual Life Assurance Society in relation to allegations that the major bank sold its customers junk credit card and personal loan insurance. The action forms part of ASIC's priority to tackle consumer harms in insurance and follows its detailed review of the sale of consumer credit insurance by 11 major brands and other lenders. They issued a report, number 622, Consumer Credit Insurance, Poor Value Products and Harmful Sales Products, published in July 2019, and that revealed that the design and sale of consumer credit insurance had consistently failed consumers. ASIC found that this insurance was poor value. Its sales practices and product design caused consumer harm, and consumers were being incorrectly charged. ASIC's Report 256, Consumer Credit Insurance, a review of sales practices by authorised deposit-taking institutions, published in October 2011, make 10 recommendations to reduce the risk of consumer credit insurance being missold to consumers. ASIC revealed that last year, over $160 million in remediation was due to be paid to consumers who had been sold junk consumer credit insurance from 11 different banks and lenders. Many lenders have now ceased offering consumer credit insurance products with credit cards, personal loans or home loans, while cold calling for CCI has also been banned. Now, over in New Zealand, the housing shortage appears to be over, especially in Auckland, according to interest.co.nz's latest analysis of housing supply and demand. It suggests the number of new homes being consented has been exceeding the demand for new homes created by population growth for at least the last 3 years. And it also suggests that while a shortage of housing may have built up in some areas, particularly in Auckland, more than 3 years ago, historical shortfall between supply and demand is now likely to have been substantially diminished, if not wiped out. Their analysis is based on Statistics New Zealand latest population figures, which includes population changes in all territorial local authority areas based on the natural increases, the excess of births over deaths, internal migration, people moving from one district of New Zealand to another, and external migration, people moving to or from New Zealand. They then calculated how many new homes would need to be built to house the increased population based on the district-by-district household occupancy levels of the 2018 census. Those numbers were then compared to the number of new dwelling consents issued in each district. That shows that across the entire country, 30,231 new homes would have been needed to keep pace with the population growth in the 12 months to June 2019, and 30,453 new homes were consented nationally over the same period. So over the 12-month period, housing supply and demand were in balance. Then there was a big jump in population growth in the following year, 12 months to June 2020, mainly driven by a surge in net external migration numbers. That pushed annual demand for new housing up to 42,692 additional dwellings, while dwelling consents increased more slowly to 37,614, leaving a shortfall of around 5,000. However, that shortfall was then more than made up for in the following 12 months, the year to June 2021, when border closures saw a dramatic decline in overseas migration, which pushed the annual demand for new homes down to 12,462. New dwelling consents were not affected by lockdowns and border closures and continue to increase rapidly to 44,299 in the year to June 2021, giving a surplus of supply over demand of 31,837 homes for the year. That surplus of new homes would have gone a considerable way towards diminishing, if not wiping out, any accumulated shortfall in housing supply over previous years. Because migration remains severely restricted and the number of new homes being consented continues at near record levels, it's likely that the supply of new homes is continuing to outpace population-driven demand by a substantial margin. However, it's worth noting that although consents are generally a reliable indicator of building activity, not everything that gets consented gets built, and construction times can vary significantly. Meanwhile, there are of course significant regional differences. Some of the most compelling figures are those for Auckland, where migration-driven population growth has been greatest, but what was a reasonably modest surplus in supply turned into a flood in the 12 months to June this year, when the dramatic decline in migrants coming to Auckland saw the region's population decline for the first time since records began, and the surplus of housing supply over demand skyrocketed to almost 19,500. So it's likely that 2021 was the year when housing supply caught up with housing demand in Auckland and possibly overtook it. This has important implications for Auckland's housing market. An increase in supply over demand could relieve pressure in the rental housing market, increase vacancy levels, and will put downward pressure on rents. When combined with rising interest rates, this will also put downward pressure on property prices. Other regions where the supply of new homes exceeded population-driven demand were Canterbury and Otago. However, there are also some regions where supply was falling short of demand, most notably in the Upper North Island, in areas such as Northland, Waikato Bay, Bay of Plenty, Gisborne and Hawke's Bay. In particular, the supply of new homes in the Bay of Plenty has fallen woefully short of the demand created by the region's population growth. And finally, this in the opinion section of the AFR by Grant Wilson, the head of Asia Pacific at Exante Data, a macro advisory and data analysis firm. He says the RBA does not have sufficient capital if it is to increase rates anytime soon. The price action at the front end of the global yield curves last week was wild and unhinged. Australia was the epicentre, as the Reserve Bank is now set to make history as the first central bank to exit the policy referred to as yield curve control, or YCC. The exit was never going to be pretty. Credit to Bill Evans at Westpac, who in October 2020 noted that fixing both price and quantity of money may lead to unexpected difficulties down the track. Quite. Beyond the market dislocation, the abrupt repricing poses an additional headache for the RBA. It is depleting the capital held in the Reserve Bank Reserve Fund, the RBRF, and opened up a situation where the RBA will need to request a recapitalisation from the Treasury, i.e. from taxpayers. There is a precedent for this. In 2013, incoming Treasurer Joe Hockey signed off an $8.8 billion grant requested by the Reserve Bank Board to increase the RBRF to 15% of assets at risk. He had a pop in the process, attributing the depletion in part to the determination of the previous government to take extraordinary dividends from the Reserve Bank. The setup this time around is different and owes principally to the dramatic expansion of the RBA's balance sheet through the pandemic. Bear in mind the purpose of the RBRF is to absorb losses that might reasonably be anticipated from time to time. To achieve this, the board uses a framework that assigns capital to various risks on the balance sheet, including credit risk and market risk. Now, the Australian Financial Review reported last month that the framework was reassessed at the end of the financial year. In its annual report, the RBA said that it was appropriate to do so, given the significant change in the size and structure of the bank's balance sheet, the change in the operation of the monetary policy, and the changed nature of the risks. The most important shift was to dispense with capital provisioning for the domestic interest rate portfolio. That would have required a $27.4 billion, or roughly 1.5% of GDP, based on a scenario of a 200 basis point rise in yields. The RBA justified this step by highlighting intention to hold these low-risk instruments until maturity. And the RBA also made a new provision of $2 billion to cater for, quote, earnings at risk. Combined with provisions for foreign exchange and the international interest rate portfolio, the RBRF was set at $15.4 billion. Putting aside the unique privilege the RBA has in setting its own capital provisions, the margin the board left itself was wafer thin and already eroded by market developments. There are four factors in play here, the last of which is the least understood and the most pernicious. First, the significant repricing in bond markets has exposed the RBRF to mark-to-market losses, especially on the domestic portfolio. The weighted average maturity of the $310 billion bonds purchased via the bond purchase program and long-dated open market operations is just shy of 6 years. The average curve shift is about 70 basis points since June the 30th, and hence those losses are around $10 billion based on standard duration metrics and consistent with the RBA's stress tests of 200 basis points. Although the RBA is unlikely to revisit its decision to exempt those holdings from capital provisioning, it exhausted what it referred to as the unrealised profit reserve last year. Hence, if those losses are sustained to the end of the financial year, there will be a direct drain on the RBRF. That happened in 2011 when the RBA acknowledged that with no unrealised gains held in the unrealised profits reserve for investments, net accounting loss is fully absorbed by a transfer from the RBRF. Second, on the positive side, the RBA will earn significant income on its holdings this financial year. This is because it is funding both its bond holding and the $188 billion extended to banks via the Term Funding Facility at zero. This comprises about $100 billion of notes on issue and $400 billion of exchange settlements, ES balances. The average coupon on the bonds held is high at 2.66%. This contrasts with the Term Funding Facility, where banks secured funding at around 0.17% on average. And that's a nice little earner for the RBA, about $8.5 billion for this financial year. But third, and against this, is the pull-to-par effect of the high coupon bonds that were purchased. The RBA recognised the unwinding of these premiums on a straight-line basis. Last year, this led to a loss of $2.7 billion. In the year ahead, the loss will be materially higher as more bonds are held and for longer. That could be somewhere around $6 billion. And fourth, and here's the rub, if the RBA does increase rates, it will need to compensate ES balances at the new cash rate. This will reduce its earnings by narrowing the spread to the coupon of the bonds held. The higher the rate goes, the bigger the impact, roughly $4 billion for each percentage point. This sensitivity will reduce once the TFF is repaid, but it's worth noting that with just one rate hike of 25 basis points, the TFF becomes a negative carry trade for the RBA. With the average term of the TFF exceeding 2 years, timing matters. This point is precisely why the RBA took the additional steps of provisioning $2 billion for earnings at risk. However, that was based upon market pricing at the time. Were the same exercise to be rerun after last week's dramatic sell-off, a provision of around $5 billion would be more appropriate. To be sure, none of this is a near-term constraint for the RBA. Moreover, the RBA acknowledged that the valuation losses in any given year could exceed the balance in the RBRF and result in a negative equity position. They emphasised that such an outcome would not affect the Reserve Bank's ability to operate effectively or perform any of its policy functions. The politics, though, are tricky. Unlike the Bank of England and the Reserve Bank of New Zealand, the RBA did not secure an indemnity from Treasury for losses resulting from large-scale asset purchases. Moreover, if an early and sustained tightening cycle were to ensue, the losses would escalate and become a significant fiscal burden just as budget repair becomes a priority. Alternatively, the RBA might change its provisioning rules again and even be tempted to operate from a position of negative equity, if it comes to that. The RBA has paid some $41.6 billion to governments via dividends since 1998, and hence there may be an expectation that any deficit can be earned back over time. That, though, is not a realistic assumption if the cash rate moves materially above the average yield to maturity of the assets that were purchased, which is around 0.57%. Instead, there would be a persistent drain on the RBA's capital in the years ahead, and that would be the price to be paid by Australians for quantitative easing. And I'll also make the point that this highlights how well placed the major banks are now with that ultra-cheap term funding facility money sitting there for another 2 years plus. Taxpayers, you're bailing out the banks, and taxpayers, you may even have to bail out the Reserve Bank, thanks to bad policy, too much quantity easing, and ultra-low interest rates. We are past the limits here. Time for review of the RBA. Now, if you're buying your home in Sydney's contentious market, You don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.